Aussie household mortgage stress peaks. Hi, everyone, and welcome to Ainsley Insights, brought to you by Ainsley Bullion, Ainsley Crypto, and the Gold and Silver Standard, as the Ainsley Group celebrates 50 years. Well, first of all, happy Bitcoin all-time high in Australian dollars day, Branko. I
Yeah,
thought I'd start off sort of saying that because you've got a pretty dire outlook that you're giving us today in terms of the Australian housing market, but it's exciting in the Bitcoin front at least. So how are you going today?
yeah, good, good. Oh, mate, on the crypto front, it's looking quite well. 60K US and like I said, all time high in Australia. So obviously different what we usually talk about, but
Yeah, we could talk about that a lot. That is not what you talked about in the news today. So we'll go down that path instead. But interesting article today where you're really identifying something that was a little bit scary on the surface. That's why to start off with something positive. But you were really talking about mortgage stress being reaching really very high levels here in Australia. But I thought, can you maybe start off today by just explaining to us this concept of what mortgage stress is and how it affects homeowners? Because I think that background will be really important.
yeah. So basically, probably as you can assume, just when homeowners spend a disproportionate amount of their income paying off their home loan, generally it's considered to be more than 30% of households' pre-tax income.
Right.
And obviously, I think it's a good indication for probably like the average person's general health towards the economy. A lot of people are having mortgage stress. Generally, obviously, that means probably bad news for the general economy because less people have that discretionary income to spend. So there were some alarming trends we can get into now, and in the data that Roy Morgan produced.
Yeah, because I was very interested in what that data had to say because it certainly painted a picture. So can you maybe step us through some of that data and really identify what that means?
Yeah. So basically, 800,000 more homes were over the past 18 months were added to being at risk
Hmm.
of mortgage stress. And it basically overall we have over 1.6 mortgage holders now at risk, which is 31% of homeowners. That is obviously crazy to think about that 31% of homeowners are using a disproportionate amount of their income on their mortgage and being forced to do that. So that's kind of probably the basic data to start with, and they get into the weeds about the different categories as well. And people are kind of at a lower risk level, extreme risk level. But at the end of the day, because of these rate rises, which are obviously not very surprising that we've seen this impact, but because of these rises now, we have over 1.6 million homes now at risk or, of potentially. I mean, mortgage stress basically means like, this person could default because they can't pay it. So,
So yeah,
1.6 at risk of possible default.
and would you say that that is substantially higher than what we would normally see? Because it feels like that's the case. Like what?
Yeah. So I just want a quick graph actually I can put up of extremely at risk mortgage holders, and this is the most extreme category. And right now we're at around 20%, and usually it hovers between like 10 to 15. And the last time we were
Wow.
this high is obviously in the GFC when there was, well, we global financial crisis for a reason. So I understand that. But this significant increase, particularly in the past 12 to 18 months, as you can see in the graph, is pretty significant and extremely worrying, and is the most worrying number that we've seen come out of this. So the rapid growth in extreme mortgage stress is extremely alarming, and I think we can get into some of the future projections and the possible outcomes of this as well.
Sure. But do you think that that's most concerning also because we have had that pause, or is this what you would expect? Because we haven't had rates go up for the last few rate sort of
Mm.
so the rate, what are they announcements, right? Like it's being steady, it's being static.
Yeah,
So is this just a lag effect that we see the increase in stress as that starts to bite? Because I know we've talked before about when a rate rise comes, it doesn't necessarily impact people straight away. There's a bit of a lag there because it might not be for the next month or the following month until they start to see that increase, and then it takes even longer for it to change consumer behavior. Is that the case here, or is this because it would concern me if this number is calculated before any of that and just saying that stress is really high right now when really we've been through a prolonged period of the rates being static? What happens if they raise them?
that's a great point. And I will say it's been pretty parabolic. And then once the rate rises cut, it's kind of stabilized. And now we've increased again this month. So potentially a sign of things to come. But they are anticipating future extreme at-risk mortgages basically to come in higher than ever. So I think we touched on the CPI as well and how that looks good from the interest rate side, that it won't increase. But there are signs that while this is heavily correlated generally to rate rises, we could be just seeing a general trend now. And, think about it logically, right? People dipping into their savings probably to cover some of these payments. Obviously, eventually they're going to run out.
Absolutely.
Yeah.
And I suppose that leads me to my final question to wrap all this up. What do you see as that future here? Is it that number comes down naturally because we expect rates to come down? I mean, that seems dangerous in some ways to be, that's a bit of a hope and pray strategy. I think that we just hoping that they come down, because there's also the potential that they don't, that they stay static. The higher for longer could be a thing that happens. I mean, I think they probably come down, but we don't know that as a certainty. What's your future projection there?
Well, firstly, Roy Morgan basically saying they expect significantly more people to enter at-risk categories than 400,000 over the next couple of months, which is worrying. However, this was done before the CPI data came out, which was generally pretty positive. So,
right.
That might play a part. But again, I think, as we discussed before in this program, the leadership of like the RBA, it's hard to have much trust in their decision making. So, it's hard to say that they're not necessarily going to make the right decision, even if the evidence presents itself. So I would say generally I would expect this trend to continue irrespective of what the broader economy is looking like. Like, if just because equities are up doesn't mean that these mortgage holders are going to be able to pay their debts, right? So, yeah.
And I do have one additional question. I thought that would be the last one, but I do have one more. Do you think that there is actually anything that the government or financial institutions can do here to help alleviate that burden? Like, is this something that ultimately the responsibility falls back on government to deal with? How do you view that?
That's a great question. Difficult for me to see how the government could potentially solve this unless I know in the US, they did things like student loan forgiveness, yes, I think, during COVID. So they could potentially implement something like that. As far as the government actually doing it, I think that's not going to happen. And of course, as we've seen in the past, they'll happily bail out big banks, but they're not going to bail out homeowners. So as far as the actual possibility of it happening, I think it's virtually zero. But potentially there are strategies they could implement, like some kind of debt forgiveness or freeze. But yeah, I don't know if you had another opinion on that. I think it's very unlikely to happen.
I agree with you. It's a very difficult situation because ultimately, the government, it's probably not the government's responsibility. You could certainly argue to bail people out when they're in that situation, but it could bring the whole economy down if you had mass mortgages, yes, at that extreme stress level where they really just had to walk away. That brings financial institutions certainly to their knees. I don't know how that works. Does it end up ultimately on the balance sheet of the central bank anyway, where they effectively have to come in and bail out those banks who are stuck with all these properties that they can't sell? It's a very it's a sobering thought to think of. I mean, that really was what started the global financial crisis in the US, that sort of situation, wasn't it?
There's actually one caveat I want to add as well, because Australia is very uniquely attached. Like, our housing market is at the core of our economy, like more than most. Maybe there is a higher chance then that the government would try and implement some measure to try and
push came to shove in that extreme situation.
Generally, again, I don't think that would happen, but because it's so core to our entire system, I mean, the property market's been going up, it seems like 10% every year since, the 70s, right? I mean, that's how the GFC. So because it's so core to the system, maybe there is a higher chance of some kind of saving grace. But again, generally, I don't think that governments would ever bail out people. I think they generally prefer to bail out banks and companies.
Well, on that note, I'll just go back to looking at my Bitcoin chart and embracing those all-time highs. So thank you for your work on that today, Branko. Really appreciate it.
No worries. Thanks, Chris.
Thanks, everyone, for watching. We'll chat again soon.